It's been a very hectic month for us. I just came back from basically all around the world. We've done our London Family Office Conference basically a couple of weeks ago, and last week I came from sunny Miami, where we held a conference at the Lowe's in Miami Beach, which is always our grand finale of the year, which we've held alongside Art Basel and all the arts happening. And today we have a special session today with the TSX and TSXV innovation, where for the first time, we'll be showing you 4 selected companies from 4 different areas. All are innovative, promising companies that we would love to show you guys today. And I will start by perhaps giving you the day's agenda. So I will be speaking for the next couple of minutes at 11:10 approximately. Dani Lipkin, who's already here with us from the TSX, is going to be joining us. And then we'll start at 11:20 with our first company, Exro, at 11:40. Taiga, I'll speak about each and every one in a second. At 12, WeCommerce, and at 12:20, Acquisitive. Each company will have basically 10 minutes to present themselves, and then 10 minutes where I have some questions and others may ask as well. And maybe a couple of words about this collaboration. So again, we're thrilled to bring some of the best of Canada's executives and cutting edge companies to present their story to the family office and high net worth community across the world. And we will be speaking, my first speaker in several minutes, as mentioned, is Dan. Dani Lipkin is the Director and Global Business Development for Toronto Stock Exchange and the TSX Venture Exchange. In this capacity, is responsible for working with private companies and their shareholders as they explore and consider the option of raising capital in Canada. Before this role, Dani was the head of business development for exchange-traded funds, ETFs, and investment funds on the TSX. He'd also worked with the listing groups for TSX, listing groups, where he helped assist companies in going public. He has a Bachelor of Management and Organizational Studies in Finance from the University of Western Ontario and an MBA from the University of Toronto. So before Dan will be opening our session, just a couple of words about the presenting companies. As I've mentioned, the first company at 11:20 is Exro Technologies. We'll be speaking to Sue Ozdemir, the CEO, and that's a clean technology company pioneering intelligent control solutions in power electronics to help solve the most challenging problem in electrification. So innovation in electricity, if you will. At 11:40, we'll be jumping to a completely different space, Taiga Motors Corporation. Basically, they were founded in 2015 with a vision to basically make a revolution in the power sports industry with electric vehicles that outperform peers without sacrificing the environment. So basically innovation in extreme sports in a way, while keeping the planet a safe place. And I'll be speaking to Samuel Bruneau, and who's the CEO and co-founder. At 12, I'll be speaking to Alex Patterson and David Sharon from WeCommerce, that provides merchants with a suite of e-commerce software tools to start and grow their online store. They're pretty impressive. In the family of companies and brands include Pixel Union, Out of the Sandbox, Archetype, Upify, Supple Apps, Rehash, Fork 60, and Stamped as one of Shopify's first partner since 2010. They are focused on building, acquiring, and investing in leading technology businesses operating in their ecosystem. And finally, at 12:20, we'll be speaking to Mike Reinhardt, that founded Acquisitive in 2016 and serves as their CEO and board director. They are a premier global Microsoft partner that harnesses the Microsoft platform and complementary technologies, including custom solutions and first-party offerings, to generate serious impact for enterprise customers. So that's going to happen at 12. And we're very excited because this is truly a different kind of a session. Normally, as you guys may know, we have one presenting companies, and hopefully this is one of many sessions we'll be holding with the TSX. As you may also know, the Canadian market is a major market of ours, where we are holding family office conferences for several years now in Toronto, and this year in Montreal and Vancouver, with great partners like Fasken and other great names. So Dani, good morning, and you are in Toronto, I believe.
Of course, freezing cold Toronto here.
I'll let you take the lead now, and I'll join you back very shortly.
Thanks, Dani, and pleasure to meet everybody. I'm just going to bring up today's presentation for everybody to see there. So good morning, good afternoon, wherever everybody is today. As Dani mentioned, my name is Dani Lipkin. I'm a director in global business development here at TSX and TSX Venture Exchange. And my role is to head up our innovation sector. And what innovation means to us is companies in the technology, clean tech, and life sciences sector. So the very fast growth, high emerging growth sectors overall. We have 4 very interesting companies speaking today from a multitude of different sectors. But before we get to their presentations, I wanted to provide everybody with a bit of an overview of TSX and TSX Venture Exchange, if you're not familiar with it, and how we're really kind of leading the charge in the innovation space. And, not just these 4 companies here presenting today, but the multitude of opportunities available to investors, and how we've been focused on the innovation sector over the last number of years. So just to give you a sense of how big TSX and TSX Venture Exchange are, we are one of the leading centers for capital in the world. If you look over the last 5 years, Canada is the 4th largest country in terms of equity capital raised after China, US, and the UK. What you won't see on this slide is financial center power hubs like Japan and Germany in terms of their ability to raise equity capital as compared to the Canadian markets. And we raised $43 billion on TSX and TSX Venture last year. Through October this year, we're actually up to $47 billion of equity capital raised. And a major portion of that is actually within the innovation sector, which I'll get to very shortly. And why we are able to raise so much money here is because it's not just Canadian investors who are coming to our markets, but it's actually the world who invests in our companies. So on a daily basis, about 40% of our trading volume actually originates outside of Canada, and 25% of our member firms are actually located outside of Canada. You'll see the largest global banks listed here. We obviously have a close nexus and tie to the US, and ability of US investors to trade in Canadian names on the same time zone. We also see this just in terms of a lot of the IPOs that come to TSX and TSX Venture. A good percentage of the investment dollars actually originate from the US overall. And what we're also seeing over the last number of years, it's not just Canadian companies who are listing here, it is global companies. We have, over 220 international companies who are listed on our 2 marketplaces. Obviously, there's a huge segment of that comes from the US, given the natural proximity. But what we've seen over the last number of years is a lot of Israeli companies, specifically in the innovation space, who have come listed in Canada. Just a few years ago, we actually hired and placed somebody on the ground in Israel. And we've seen this year alone, another 5 companies from Israel list on our marketplace. Historically speaking, what people have thought of the Canadian market is really centered on the natural resource sector. So mining and oil and gas historically have been 2 of our primary focuses in terms of our GDP and our stock list on TSX and TSX Venture. But what we've seen now is this dramatic shift towards the growth sector. So, as at December 31st, the growth sectors actually represented almost half of our total market capitalization. So that is a significant shift that we've seen over the last number of years in going away from the traditional financial and natural resource sectors and really focusing on the innovation and growth economy overall. Now, just to explain TSX and TSX Venture Exchange for those who are not familiar with it, as today we actually have some companies who are listed both on TSX Venture and TSX Presenting. These are the 2 marketplaces that we actually run. So the TSX would be our senior exchange comparable to New York Stock Exchange, NASDAQ, London Stock Exchange. And you can see on the left-hand side of these slides what the typical financing size would be for innovation companies and what the average market cap value would be. So 3.2 billion would be the average market value and 151 million would be the average financing side. On the right-hand side is our TSX Venture Exchange, which is geared towards smaller and medium-sized companies who are really in the growth cycle stage, and really it's a way for them to go public at an earlier stage than anywhere else in the world. So the average financing size that we'll see for innovation companies on the TSX Venture is about $10 million, and the average market cap will be $80 million. And our goal with all these TSX Venture Exchange companies is to actually graduate them up to TSX. Exro, one of the companies presenting today, is an example of that company who has actually graduated up from TSX Venture to TSX. So over the history of the TSX Venture Exchange, we've actually seen over 700 companies graduate up to TSX. Right now, we have 102 TSX Venture graduates that have a market cap of over 500 million. 38% of all innovation companies on the TSX actually started their lives on the TSX Venture. And the last stat that's not here that I'd rhyme off is that 20% of our S&P TSX Composite Index. So that is the largest, approximately 230 companies on our markets started their lives on the TSX Venture Exchange. And you'll see at the bottom, different sorts of companies that started their lives on TSX Venture and graduated up to TSX. And this is just going back to the earlier point of where we're seeing the growth and demand from our new listings overall. So over the last 5 years, the innovation sector has been the #1 driver of new companies listing on our markets. And just mindful of time, so these are just some of the leading Canadian global innovators listed on our marketplace. For a lot of people who may not be aware, Shopify, which is now one of the largest companies listed in Canada, IPO just 5 years ago on TSX and on New York Stock Exchange with a $1 billion market cap, and now it's a $200 billion market cap. You also see that we have a very strong segment in the renewable and clean tech space, and also in the life sciences space. And the reason for this huge demand in innovation has been the returns overall. So over the last decade, the S&P TSX Tech Index has actually outperformed the NASDAQ 100. I'll repeat that. The TSX Tech Index on an annualized basis over the last 10 years has outperformed the major indices across North America with an average annualized return of 24%. It is, full stop, one of the best performing sub-indices anywhere in the world over that decade. And investors still have a large appetite for these innovation companies because of the great returns. And just to recap what we've seen thus far through the first kind of 10 months overall is $19.8 billion of equity capital raised in the first 10 months of the year. This surpasses any full year record for the innovation space. And you can see at the bottom just a handful of the new companies that have listed with us year to date. So there's been about 73 new companies listed with us. And these are just a couple of the different ones, including TELUS International, which is the largest tech IPO in TSX history, having raised close to $1.4 billion earlier this year. And just as we're running out of time, you can see that we've had significant interest in both IPOs and follow-on financings through the first 10 months of the year. Our tech market cap has grown 500% in the last 5 years. It's just at 81 billion 5 years ago, and now we're up to about $440 billion. So I want to thank everybody for listening to that little kickoff presentation. If you have any questions about our marketplace, my contact information is listed there. And we have coverage, as I said, across the world with presence in Israel, Europe, South America, the US, and all over Canada. So feel free to reach out to any of us if you have any questions. And with that, I will pass it back to Dani before he introduces Sue and Exro.
Thank you, Dani. Thank you for your kind words here. Very exciting to open with Sue. So Sue Ozdemir, she's the CEO of Exro Technologies. She will be letting us know more about the company. So I'll leave it for her. She's an industry veteran and proven corporate leader with an extensive background in the development, sale, and manufacturing of electric motors. She spent nearly a decade at General Electric and was the CEO of GE's small industrial motor division, overseeing the North American and international markets. Her passion for the industry combines with her technical background and strategic mindset has made Sue a rising star in this dynamic industry. At the helm of Exro, she looks to bring the same work ethics and entrepreneurial instincts that helped her scale GE's small industrial motor division and guide it through the successful sale for $160 million to Wolong Electric, one of China's largest motor manufacturers. So Sue will be joining us now. We'll open with her presentation. Sue, thank you for joining us. Good to see you. Where are you in the world?
I am in Phoenix, Arizona.
Oh, and I was wondering because Dani said how freezing it is in Toronto, and I'm seeing sunshine.
Yeah, you're seeing sunshine. I'm going to turn my camera so that we don't get such a glare.
Yeah.
So we are based out of Calgary, Alberta. I'm at the new facility in Mesa, Arizona.
Beautiful. So great. So I'll let you take it from here, and I'll join you for the session part.
Okay, perfect. Thank you, Dani. I appreciate it. So thank you, everybody, for joining, and I look forward to telling you a little bit about Exro. Thank you for the introduction, and I'm just going to jump right into the company. So Exro is a power electronics company. So how you can think about us is really we make controls that control and optimize motors and batteries. And we focus on everything from the design as you first go into a powertrain system and how we improve performance and cost, through to utilizing the batteries that come out of a vehicle into second life. And our power electronics is really what we have been focused on and what is the core capability of Exro. We have two key types of technology. Our first one is what we call our coil driver. Our coil driver is essentially what you think about as electronic gearing. So if you think about Exro's coil driver, you would think about the ability to drive speed, so cruise down the highway, and torque, climb a hill with a package, bunch of packages in the back of your truck. We are agnostic to the type of propulsion, so we can do battery, fuel cell, hybrid. As long as there's a motor to control, our drive can give it optimized performance in a cost-effective platform. And then we had a synergy of our coil driver, and we utilized it to create control over the cell level of a battery. And what's really different about that is there's a lot of BMS systems in the market that are able to detect how that battery is reacting to the environment that it's in. And with our battery control system, what we really do is control to what's called the cell level. So right down to the core of the battery pack. And we're able to utilize second life batteries into a first life application. Our technology on the coil driver was recently validated through a third-party independent certification lab called AVL. We chose AVL because they were, first of all, independent, so we have no partnership with them. They are an accredited laboratory, and they're recognized in the automotive industry as one of the top independent test certification labs. On the screen in front of you, that is the actual test facility at AVL with our 100-volt drive. And that drive was able to show that we could traditionally control speed and torque. So essentially, for the non-engineers, we can gear electronically versus through a heavy mechanical gearbox. This has the potential to reduce weight and the cost of powertrains, and I'll get into why. That report is available on our website as well. If you think about a typical electric vehicle, doesn't matter what type of vehicle it is, anything in the industry, 4-wheel up to 18-wheel, what you're going to see is 6 main components to drive the electric platform. You're going to have a battery, you're going to have what we call a classic inverter, the motor, the gearbox, wheels, and onboard chargers. Some vehicles don't use gearboxes, others do. Everybody has the other components. And the reason for that is basically you're storing power from your battery. The inverter is inverting that power into the motor, which then sends the power and turns the wheels. We don't alter that powertrain. What we do is replace that inverter, the incumbents in the market, the Denzos, the TM4s, the Borg Warners, and we replace it with our Exro inverter, meaning that they can essentially drop in to what's already there. But with our inverter, they can now utilize less motors. They can reduce or eliminate out 2-speed gearboxes. And with our new charging feature announced in July, we have the potential to also eliminate the onboard charger. So the overall cost position as we work with tier 1s and OEMs is quite substantial, and they get increased performance, which is important for the general economy and for the general society as we look for better vehicles. We're able to put our product to market through a couple of different to market strategies. For us, the main goal will eventually be to do joint JVs for large high volume manufacturing like you'd find in the passenger vehicle market, or licensing agreements. But in order to position ourselves and to establish ourselves with a foundation, we started with an innovation center in Calgary, which is our headquarters. We've been working out of our Calgary Innovation Center for about 2 years now. We've grown our team from about 6 employees to over 60 employees. The majority of our team is in the engineering team, where we have all the disciplines from software to hardware. And then we have under construction right now in Calgary. On our social media, you can find videos of the facility and what it looks like. And it's still on schedule for end of the year production and being automotive certified, meaning that we'd be able to supply any of the tier 1s or automotive industry by end of the year through the first quarter of next year. And then we have our innovation center here in Phoenix, Arizona, where I currently am. We just opened up to our employees on Thursday. We're still building out our test and facility out back, and that will be ready for grand opening sometime in early part of Q2 of next year. We've been out commercializing over the last 18 months since I joined the company. It's been about 2 years since I joined. We really wanted to focus on establishing ourselves in individual segments that once we put out the projects, we'd know all the kind of ins and outs of that industry, and we'd be able to now mass accelerate our sales cycle. So we worked with Potentia, our key and longest partner. We are right now in on-road operations. So over the last 30 days, we've really been able to kind of progress the company through the operational validations. They've been going very, very well. They're time consuming. It's not a fast process, but we're getting it right. And it's going to establish us as a market leader in the future. So with Potentia, we've got it in a vehicle. It's been riding around their compound and kind of starting to make the first road drives. And we're starting to tweak our software and make sure that we're ready to go into production with them. With Land, we've done a recent update where we've moved from a small 48-volt system into a 72-volt system with Zero Motorcycle, one of the top electric motorcycles on the market. We own a Zero motorcycle as Exro, which we will have at our CES show in January. The drive has been integrated. We've done our first rides. We're working through outfitting the bike and making sure it's safe to get on the road. And we'll have that launched at the CES show in January. We'll be doing private test runs on the bike over the next 3 weeks prior to the CES show, and then it will ship down there. And then on the high voltage is really where we've seen a lot of demand, almost overwhelming demand from the marketplace. We started with a great partner called C Electric. Yesterday, C Electric had a press release that they have signed a contract with a local school bus manufacturer. Well, they will convert over 10,000 buses over the next 5 years. We're working on a 400 volt system for a UPS truck, which will deliver in Q2 of next year. We're working on an 800 volt garbage truck for municipal projects, which will also deliver in Q2 of next year. And those systems are the same systems that they use in the school bus. So we'll be working with C to see how we integrate into a school bus platform with them as well. They'll work through their vehicle integration, and we'll move into production for the second half of next year and be, one of their top suppliers as we move into 2023. We have the same type of deal with Vicinity Motors, our bus partner. We're working on a 400 volt system with them. It's the same system that we have with C, the same base module system, and we just customize the software to suit the end powertrain. And then of course we have our partnership with Linamar, which is a really key partnership for us. Linamar is a global tier 1 automotive supplier. They've been supplying the automotive industry for many, many years with key partners like Ford and VW. The partnership with Linamar, we were able to achieve sooner than we anticipated, and we've been working through what's called an e-axle. An e-axle, also known as a 3-in-1, is where you basically build the gear, the motor, the drive, all into one mechanical component. And the reason for that is to drive down costs so we can make this bridge to electric vehicles. And so our partnership with Linamar has been going fantastic. All of the leadership at Linamar has been pleased with our results so far. And as we progress through the partnership and we're able to share more information, we will be glad to do that. Linamar will be at our booth at CES, and there'll be a 3D model of the new e-axle that we'll be co-developing, and it will deliver to Linamar in Q2 of next year. What that really means for all of you as you look to what you can do when you're with Exro is these partnerships, while they're mostly with emerging companies in tier 1, are establishing ourselves with standardized product that once we get through 2022, we'll be able to now go out to as many motorcycle companies, as many trucking companies, as many passenger vehicle companies, and have not just simulation and test bench and third-party validated tech, but we'll have operationally validated tech. And that's really a key to how we accelerate the process. We'll have orders in the next year. We have a nice ramp up through end of next year through 2023 and into 2024, but it really scopes into a low voltage and a high voltage product line. Besides myself, I have a strong management team that I have spent a lot of time recruiting over the past 24 months. I brought on Josh Sobel, our Chief Commercial Officer, who worked at Siemens and GE as our Chief Commercial Officer, helping us to drive customer relationships and long-term relationships with our customers. He joined us last November. I have Eric Husted, who is my Chief Technology Officer. He's really a key piece of how we've been developing our tech, because Eric comes with 20 years of experience in automotive inverter manufacturing, and that's really different than automotive than industrial inverter manufacturing. And as the world changes to electric, we're focused on this $7.7 billion vehicle inverter market, but there's lots of other areas where you find controls running motors. So there's lots of future potential for Exro as well. And then our Chief Operating Officer is Richard Moe, who joins me after a career with GE as well. And John Meekison, our CFO, who's with us here today, has over 20 years experience in the capital markets, has kept us debt-free within our burn rates and making sure that we are following our commitments to the marketplace. As you look to Exro, I know I'm getting close on time here, so as you look to Exro and what's coming up next, I think the next catalysts for us are really continuing to recruit beyond our management team and our board of directors. We have a very strong mid-level management. We've recruited to put up our production facility, to have our supply chain, to build our business. We are continuing to sign customers. We have a customer under NDA that we talked about in a press release a week ago in Europe that we're working with to take a new motor, a new car to market. And we have lots of other customers in our pipeline that we're working to get out with our products, with our demos. And we're continuing to work towards making 2022 a year that we really build our backlog and hit some revenue and start to build ourselves as a leader in the space. So you can find us on the TSX under Exro and on our website, www.exro.com. And Dani, I think I'll open up for questions.
Thank you, Sue. Yeah. So someone here is asking, will Exro's BCS technology will be able to be integrated into these new charging station technologies?
Yeah, so our charging, so the BCS technology would go into a battery control system. So it'd be more on the battery side of an electric vehicle. But our charging, yes, we are working right now with different municipalities. Our charging is slightly different in that most of the market is going to DC fast charging. We have essentially what we call AC fast charging, meaning that you'd be able to charge as quickly as you can with a DC fast charger without having to rectify the voltage. So what that results in is a much lower cost charging station to be able to get the same speed of charging.
And what's the next catalyst Exro is monitoring?
I think the big catalyst for us will be deliveries to customers, which should start happening in mid-January through mid-March, and we'll be delivering low voltage and high voltage drives every time we deliver. And as we continue to work with customers like Potentia and our Italian customer, every time we deliver, we are able to accelerate that journey to revenue. And as we get more out, what everybody needs to remember is we only need to do that once. Once we get it validated out there once, now we can open up an entire segment.
Now, we see a lot in the media lately about SiC, silicon carbide inverters. How is coil driver different?
Yeah, great question. So we've been using silicon carbide on our high voltage drives since initial design. So I think in there, we remain a market leader, and where the larger companies are announcing silicon carbide production through 2024 and 2025, our silicon carbide drives will be released in Q2 of next year and ready for production by end of the year.
Now, beyond your executive management team, given what's going on with COVID, how did you find recruiting in the current economy?
Yeah, I mean, it's not easy for sure. It's definitely a challenge that we didn't have a year ago. That said, we have recruited over 18 roles in the last 90 days. We have, we put a lot of effort. We have a great recruitment team, and we put a lot of effort into it. The more we grow and the more we've built our brand, the easier it's been for us. And our new facilities are a great place to host job fairs and have people come in and see it, especially engineers. Once they see what we do, most of the engineers want to come and be a part of that because they know it's going to be something that really changes the way people look at power consumption.
And why do you think, by the way, it's challenging? Because people should be seeking for jobs in such a crazy environment. I mean,
I think I know the media says that people aren't looking for jobs. I don't think that's the case. I think the criteria for people to come and look for work is now a lot different. So I think that plays one piece in it. They're looking for a work-life balance. They're looking for a company that is driven to do something that matters in the world. And I think people's just outlook on what a job is has changed. Also, from our perspective, our biggest kind of guiding principle when we hire is we hire the right people, not right roles. So, you can openly see many roles that have been posted for a long time. We never hire a role because of desperation. So every one of our employees is somebody that has went through the ringer to get here, and we're really proud to have them.
Someone is asking, what is the time frame on the NASDAQ uplisting?
We'll have to ask NASDAQ. So we've went through our filing. Our finance team is working really hard to get all the paperwork done. We're in first set of due diligence questions, and we're hoping we'll have that uplisting sometime in the new year. I can see John just popped up. John, do we have any other kind of timing on the NASDAQ?
Yeah, I would say probably sometime in late January, early February.
Great. What's your plan for the different locations? Calgary, Arizona, Detroit?
Right. So it's really defined actually, and it's been part of our strategic roadmap for well over a year. Calgary will remain our headquarters. It'll be our focus of R&D. We have a very strong, very ingrained team right now that has been working together for well over 2 years. So they're definitely, really into the groove of it now. Our new manufacturing facility will be our headquarters for manufacturing. The key there is manufacturing boards. Here in Arizona, we'll have a second research and development and testing facility. We'll have a lot more test equipment than we have in Calgary, so that we're close to customers, easy for travel, easy to integrate with our customers. It's about a 15,000 square foot facility. And Detroit is our new electric vehicle systems. So that means we can do anything from initial design through to repurposing of the battery, and we'll be able to take in an actual vehicle, put it on a different kind of dyno that handles the full vehicle, and test the entire powertrain.
And last question, can you provide some more details regarding the new Calgary manufacturing facility that you haven't mentioned yet, and why that matters to investors?
Yeah, there was a lot of question about, we are a tech company and we're investing about just under $20 million in this new facility. But anybody that's on the Canadian side, I encourage you to give our team a call and to visit our facility, even as it's under construction. It will be a world-class facility. As we look to electric vehicles and we think about all the shortages that the world is having, semiconductors, battery chemistry, for sure the power electronics will follow. For sure we'll see it. We see it in our own supply chain. We wanted to be in control of that. As an emerging company, we didn't want to be dependent on somebody else's delivery chain. So we recruited the best of the best. Simon, our production VP, comes from the UK, where he's manufactured and set up plants for companies like BMW. And so we're really excited to have him come in and join us and kind of bring that knowledge into the Exro team. And we'll be able to deliver not only our own drives, but we could do a lot with that facility as we go. There's no other facility like it in North America. So we're pretty proud of what we're building, and we're looking forward to sharing it with our shareholders in the new year.
Sue, thank you so much for being with us. EXRO is the ticker, and I hope to see you at our in-person events.
Me too, Dani.
Thank you.
Thank you so much.
Thank you so much. My next speaker is Samuel Bruneau, CEO and co-founder of Taiga Motors Corporation. I'll let him tell the story. They were founded by a group of engineers that believed you shouldn't compromise between accelerating power sports pursuits and sacrificing the environment. Taking on one of the most challenging vehicle segments to electrify, Taiga has pushed the frontiers of electric technology to achieve the extreme power, weight, and thermal specifications required to outperform the high performance but polluting two-stroke engine. The result is the world's first electric snowmobile designed from the ground up that is faster, more reliable, and more efficient, and better connected to winter. Mr. Bruneau is responsible for the general direction and management of Taiga, contributing to the design and development of its products. Samuel, you're in Montreal, I believe.
Yes, correct. Calling in from Montreal.
Thank you. Take it from here and we'll jump to questions once you're done.
Great, thanks, Dani. Thanks for having me. Can you see my screen here?
Yes, we can see.
Perfect. Let's kick it off. Great, thanks everyone. Happy to present a bit of Taiga today, what we've been working on, how the company got started, and what we're hoping to achieve moving forward. Just pointing out here, this nice, beautiful image on the cover page, the two vehicles you see in the bottom left-hand corner are our two electric snowmobiles here operating in the pristine, beautiful backcountry of the Canadian Rockies. Taiga has really started to address a need for electrification in this new market segment that is off-road. There's been a lot of developments for the automotive space and the trucking, busing space, but the off-road segment has been left a bit behind. And it's a bit because it's smaller, but what's very interesting is there's a very big need for electrification in this segment because of the heavy environmental impact that these vehicles have. So a snowmobile, watercraft, an ATV actually pollutes almost as much as 40 cars per year on the road. So they have a very heavy environmental impact. They're loud and disruptive. And no one's really been working on electrifying this segment because of the big challenges around them. So there's been growing restrictions because of the environmental impact around access to lakes, to trails, to parks around North America and the world. And the kind of this coupled with an increasing momentum in automotive electrification has created a large demand for EVs in this new space. And that's what really Taiga saw when we founded the company back in 2015, is this really huge opportunity to be first movers in the industry and lead a transformation towards electric. Much like Tesla did on-road, Taiga had the opportunity to do this in this new off-road segment. And that's where we're at today. So we have developed a whole new suite of technologies that allow amazing electric vehicles like these snowmobiles and the watercraft to compete with the best gas platforms out there, go head to head on performance and cost to really accelerate electrification in this new vehicle space. So today we have a full offering of different snowmobile models and watercraft models utilizing our fully vertically integrated EV technology. So we developed everything in-house, from the battery packs to the motors to the body chassis platforms and control systems that allow us to go head to head with the best combustion vehicles out there and offer an amazing performance and experience. All of this connected in the back end through our remote software connectivity, allowing us to learn on the fly and continue to improve these different vehicle segments. We're kind of beyond the technology base. We're further disrupting power sports with a new direct customer model. So we sell the snowmobiles, the watercraft, and other future products directly to customers, offer financing directly to customers, which really allows for a better customer satisfaction, a better overall experience, and improved margins for the company. We're really innovating from end to end here, starting with, like I said, our base technology. So a growing patented portfolio of different technologies here, from electronics to battery systems to motors, inverter drives, the whole vehicle platforms, the thermal management systems, and all the advanced controls that allow these vehicles to operate in the different extreme conditions. We're going to market with our first products, which are the electric snowmobile and the electric watercraft. Alongside these, we offer different accessories and apparel. And then in the future, also starting to sell our powertrain technologies, which are really unique and offer great advantages to different companies in the off-road segments looking to electrify their platforms. We do everything in-house, building from an amazing engineering team to vertically integrated manufacturing at our facilities here in Montreal. From the facility going to customer delivery, offering an amazing lifecycle experience on the product and ownership experience through services like our charging network, offering financing directly to prospective customers, servicing the vehicles through our partners, and offering remote subscriptions so you can keep improving your vehicle even after you purchase it. All this is connected through the Taiga Cloud, through our e-commerce solutions, fleet management solutions, and we're able to gather this vast amount of data to keep improving our different vehicle platforms and keep our competitive lead over the incumbents in the space. What's really interesting about Taiga, I think, is our approach to engineering and product development, which really sets us apart from everyone. We started a bit counterintuitively by selecting the snowmobile as our initial go-to-market platform, knowing that the snowmobile is maybe one of the hardest vehicles to electrify out there. You see a picture of it here, you know, extreme cold weathers, charging through the snow, going off big jumps, under heavy impact loads. So all of these are really big challenges for battery operated vehicles, typically losing a lot of range in cold weather and having difficulty with sustained power conditions and high shock and vibration environments. We're able to get around all this by developing this proprietary technology, knowing that if we could make a snowmobile that competed against the best gas ones out there, then that same technology would be able to efficiently scale to different platforms. Here we see a few pictures of our snowmobiles in operation. So we offer three main models. We have the Echo, which is the red one. That is a mountain backcountry model meant for deeper snow conditions. Our most popular one, the Nomad, the white one you see here, is our utility model used by ski resorts, tour operators, parks, and kind of recreational utility users. And then we have the blue one, the Atlas, which is the crossover, more trail-focused performance model. The snowmobiles start at around a $15,000 base price, which is very competitive with existing combustion models. You're looking prior to incentives at around a $3,000 premium compared to equivalent gas models, and you recover that very rapidly through savings on fuel and maintenance In fleet condition, that's over $2,000 a year. So you're looking at a break even in under 2 years of ownership, which is why we're seeing such huge adoption rates with our fleet customers. We achieve really great cold weather performance, losing only about 5% range at -30°C. That allows us to achieve up to 140 kilometers of range per charge on our extended battery models and offer really amazing performance, unrivaled torque for if you're looking at low-end towing, or if you're in the performance segments, amazing acceleration. So 0 to 100 kilometers an hour in under 3 seconds, the fastest accelerating snowmobile out there. After the snowmobile, the kind of natural transition for our product was we have a winter product, then we have a summer product. We're able to manufacture both these different vehicles on the same production line, summer, winter, to keep an even flow of units throughout the year, and using the same inner components between both models. So the electric watercraft here, the Orca, was designed from a clean sheet, really beautiful product, a really captivating different consumer bases and offering all the amazing performance you'd want out of a watercraft. So, top speed over 100 kilometers an hour, amazing agility and handling. You can go water skiing behind this. You can tow tubes behind this vehicle for up to 2 hours of use out on the water, easy recharging down the dock, either on 110, on 240, or at the bigger marinas, also offering DC fast charging to get a lot of miles out in the water if you're looking for. But what's really redefining this industry is you get all the benefits you'd want out of an amazing performance watercraft with none of the downside. So these are very silent to operate. All you hear is the water kind of rushing out along the hull. They're clean, zero emissions, so amazing user experience out on lake and waterways without disrupting anybody, and a zero hassle ownership experience. So there's no oil changes, no engine maintenance required on these craft. They actually use the same components inside as a snowmobile, so you can leave them outside in the winter, no winterization required. So it's really kind of changing the whole industry on how people perceive the benefits of the personal watercraft. As I mentioned, behind these vehicles are Taiga's proprietary technology platform. So this is really what sets us apart from any competition. Taiga is the first and still the only company in the world to have developed an electric powertrain from scratch specifically for the off-road industry. These components, so the motor inverter, battery, electronics, charger, the dashboard, all the connectivity and software that go into these vehicles is proprietary to Taiga, really across a growing patent portfolio. 95% of these components are shared between the different vehicle platforms, be it the snowmobile, the watercraft, and our upcoming side-by-side vehicle models. And that's really important because the powertrain represents almost 50% of the whole cost of the vehicle. So by sharing these components, we're able to achieve better economies of scale, reduce price points, go to market faster, use the same capital investments across the production lines, and really kind of drive better product benefits for the different users. Taking this integration further, the powertrains are used in our own vehicle platform, but we have really great interest and are working with some large established OEMs in the off-road commercial space that are looking to electrify their own vehicle platform. So Taiga is the first company in the world to be coming to production with this bespoke off-road powertrain. And other off-road vehicle manufacturers are now looking to electrify their platform and turning to Taiga because we're offering by far the lowest cost, highest performance solution out in the market. So we're able to produce both these in parallel and gain economies of scale and kind of data learning from the deployment on our own vehicles and through partner vehicles to create this nice positive feedback loop to continue increasing market share and reducing costs. These units are made right here in Montreal in our phase 1 facility. So this is a facility that has up to 10,000 unit per year annual capacity, a fully automated battery line from the cell all the way up to the battery pack, using this modular platform, which I just talked about, which allows really efficient CapEx sharing for greater efficiency. We focus in on precise automation to reduce costs without sacrificing flexibility because we want to be able to retain that for faster iterations. Again, on this modular line, we use the same assembly line. The powertrain line feeds into the snowmobile, feeds into the watercraft, across the year. And all this assembly line is connected to the same backend database as our vehicles. So we're able to track, from a part level going into the vehicle, the assembly, all the way to deployment and how the user is using it, take all that information, process it, and keep improving our different platforms. Once a vehicle is deployed, an important factor here is the charging network. So Taiga recently announced just a few months ago the deployment of the first off-road charging network. A lot have been focusing on road, but Taiga wants to really bring that beyond the road and offer a seamless charging experience to all our users that seek to explore some of these most beautiful places across the world. And to that end, we've announced over 1,100 charging sites to be deployed between now and 2025 to electrify over 75,000 kilometers of routes on waterways and trails across North America. And this is allowing us to gain access to some of the most beautiful sites in the world. Taiga's installing the chargers, and we have first rights to install future generations of chargers. Initially, this experience is free to Taiga users, and then as we grow in scale and other vehicle manufacturers start to electrify their platforms, we're going to look to monetize the charging network moving forward. It's been a pretty incredible year here in 2021 for Taiga. The company's undergone transformative growth. Just some quick numbers. Over 2,600 pre-orders as of October. This is almost 120% growth since the beginning of 2021, and that momentum is continuing to increase as we've seen really strong demand for our product surging in the past 12 months. We now have over 110 commercial fleet partners, with multi-unit orders. Some of these fleets have up to 500 units in size, looking to electrify over the next few years. Our phase 1 facility here in Montreal with a 10,000 unit annual production capacity, and our phase 2 facility coming online in 2022 with an 80,000 unit production capacity, addressing a total off-road market of around $400 billion globally. Rapidly deploying these charging sites and hiring some of the best talent around the world, especially in the engineering department. Now over 160 employees full-time at the company, has tripled in size since the beginning of 2021, and recently having gone public and raised $160 million in the past 12 months as a company. Quickly, just to wrap it up, the growth prospect, I think Taiga has this really unique opportunity to be a first mover in a space and redefine an industry. So we're looking to accelerate the electrification on the existing vehicle platforms, the snowmobile and the watercraft, building an amazingly engaged rider community, offering a lot more demos in the upcoming year. We have almost 100% conversion rate when someone sits on one of these vehicles and drives it to proceed to order afterwards, continuously improving these vehicle performances through deployed fleet learnings, and really continuing to invest in R&D because that's what sets us apart from everyone else in the space, and then looking to the future to deploy new vehicle platforms and technologies to grow. Thank you.
Thank you. Just a couple of questions in the 4 minutes we have. Can you talk about your target customers? Who are they really?
Yeah, we have a bit of a diverse set of target customers. So initial target customers, a lot of fleet owners. There's a really big advantage for them to go electric on cost savings. They put a lot of kilometers on these vehicles. So ski resorts, hotel operators, tour operators, national parks. Those are really our initial base of target customers. Beyond that, it's recreational riders. So people, especially on the watercraft market, that are using these, mostly for fun, for recreation. And there's a really interesting marketplace because 50% of them are people that have gas models that want to switch over to electric, and 50% of them are actually people that have never bought a snowmobile or a jet ski before because they're loud, because they're polluting, but they're so much fun to drive, and now the downside is gone, so they're happy to go electric.
By the way, what's the price range?
So starting at $15,000.
$15,000. And you position yourselves as a tech company. Why not an electric vehicle company and that's it? Why would you position yourself that way?
Taiga is really a tech company first because that's what's enabling these vehicles to achieve the performance that they do. Developing, bodywork in a chassis is not nearly as complex as developing all the software and electronics behind it to enable this performance. So that's where really Taiga focuses its efforts on, and its IP, and beyond our initial product platforms, looking to partner with other established players to be selling our technology into their vehicle platforms.
And interesting question. Infrastructure and support is a huge hurdle that the EV industry is working to address, given your products are operating in a new industry, but also remote geographical areas. How are you planning to address that?
That's really through the deployment of our charging network. So be it at marinas, some popular trailheads, or even some backcountry charging stations powered by renewable energy that are off grid. We're going to be seeking to offer, really that seamless experience so you can go explore wherever you want to without having to worry about range.
Can you explain how you think about your go-to market strategy? How have sales been so far?
Yeah, the demand has been really incredible. Right now we have more demand than we can produce, and we see that tendency, much like kind of Tesla has seen in the past years, maintaining itself as we start rolling out more and more products into the market. A significant backlog because Taiga is the only electric vehicle manufacturer in this space at the moment.
Got it. Well, thank you very much for being with us here today. And I hope to see you at our in-person events coming soon. So the ticker is TAIG. Thank you, Samuel.
Thanks, Dani.
So my next speaker is Alex Persson, President, and David Sharon, CFO of WeCommerce. I'll let them tell the story of the company. I'll just say that before joining WeCommerce, Alex co-founded. Alexa, stop. Sorry about that. That's the world I'm living in. Before joining WeCommerce, Alex co-founded the technology investment group at Jefferies Financial Group, a diversified investment holding company. And because we don't have a lot of time, I will let both of you tell your story. By the way, who is Alex? Because both of you are, it says Alex. So Alex, raise your hand. Okay, so I will change your name, the no Alex, David. I'll let you take it from here, Alex. And where are you guys, by the way?
Hey, Dani. First of all, thanks for having us. I'm based in Los Angeles, down south of California, and Dave, our CFO, is in Toronto.
Great. I'll let you take it from here, and I'll work on changing Dave's name here. Thank you.
Thank you very much. I'm just going to put up the slides real quick. Give me 1 second. Okay, well, good morning and good afternoon, everybody. I say, first of all, thank you for bringing Taiga to my attention. That sounds like an awesome vehicle for the winter, so I'll be sure to check that one out. And thanks again, Dani, for having us. So my name is Alex Persson. I'm the CEO of WeCommerce. I'm joined by Dave Sharon, who recently joined us as CFO after spending north of a decade with various TSX listed public companies. WeCommerce is a e-commerce technology company where we provide a suite of software, tools, and services to merchants, primarily those on the Shopify ecosystem. And so what we do today is provide functionality that enhances the look and feel of a merchant storefront. And I'll get into why this is such an interesting and massive opportunity in the slides ahead. A little bit of history before we get started. So WeCommerce, through its portfolio companies, has been around for well north of a decade. WeCommerce in its current incarnation, however, only started in early 2019. We have 4 key brands today that together provide software and tools and services to merchants. And those are Pixel Union, Stamped, Archetype, and 460. Pixel Union was originally founded in 2009 as one of Shopify's first partners when Shopify had less than 100 employees, frankly. And over the past decade, we've grown through acquisition as well as product R&D. And we are now a business that does approximately 10 million of revenue in a given quarter with close to, actually a little north of 30% EBITDA margins. over the past, I'd say 14 months or so, we've really transformed the business. We went public in December 2020, where we raised $60 million, kind of bookended by some really marquee investors that I'll touch on later. We're fortunate to have some really strong long-term backers in our company today. Shortly after that RTO, we acquired a business called Stamped, which was a leading provider of reviews and ratings and loyalty and reward solutions for merchants operating primarily in that customer engagement space with e-commerce. Most recently, we acquired a business called Archetype, which is a premium provider of what we call themes. And these are essentially pre-made storefronts that a merchant will buy. And together with our existing theme business, we sell tens of thousands of those in a given year. Where we are today, as I kind of alluded to, for the first 9 months of 2021, we generated around 26.3 million and $8.1 million of adjusted EBITDA, representing over 90% year-to-date growth on a constant currency basis. Since we started, we've acquired 8 companies. We've invested about $90 million of equity capital, and our M&A pipeline, as we are a fairly acquisitive company, is sizable, with well north of $100 million of revenue in that M&A pipeline, representing hundreds of millions of potential transaction value in our pipeline today. Our market opportunity is quite simple. We are playing squarely in the growth of e-commerce, and especially e-commerce enablement. So e-commerce today is a $5 trillion industry that grew north of 25% in 2020, and will continue to grow at attractive double-digit growth rates in 2021. When you zoom in a little bit about our immediate opportunity, we're operating in that Shopify partner ecosystem. And for those of you who are less familiar with that ecosystem, I'll share some tidbits. But there are 1.7 million merchants on Shopify at the end of 2020. There are over 7,000 listed applications that provide enhanced functionality for a storefront. And really, these are critical components for a merchant to grow and start their business. And so if you think about Shopify, it's much more of an operating system where they need an application layer, just as you do with an iPhone, to really make that storefront useful and effective and grow in today's very competitive market for merchants. And so Shopify is really the second largest e-commerce platform next to Amazon, and it continues to grow. They processed 25 million of payments through their ecosystem in 2017. That's grown to 120 billion as of 2020. The ecosystem is really integral to the business model of Shopify. And Toby, the founder and CEO, has very much referred to Shopify as an operating system, where you have the underlying infrastructure, which is increasingly focused on payments, and to a lesser extent, providing a fulfillment network to rival Amazon. But they've invested heavily in a free market approach to build up a collection of applications and designers and agencies who can fulfill the vast needs of over 1.7 million merchants. You can imagine the person selling subscription razors in Southern California is going to have very different needs from those selling high-end furniture in Europe. And as a result, the ecosystem has grown up around Shopify over the past 10 years, which is the key differentiator for Shopify vis-a-vis its e-commerce competitors, whether that is Wix or Squarespace or BigCommerce. And so there's over 7,000 listed applications in the Shopify ecosystem. There's over 350,000 premium themes sold in the past couple of years. And there's tens of thousands of agencies serving this growing merchant community. And I think one of the key telling stats to show that Shopify is actually an operating system is the fact that almost 90% of Shopify's merchants rely on applications to power their store. And so WeCommerce is very much aligned with this ecosystem, meaning we provide applications, we provide themes, i.e. pre-made premium storefronts, and then we have a small agency comprising about 10% of our revenue today. You can see on this slide that the vast majority of our revenue is digital product revenue, which is close to 90%. And frankly, the majority of our revenue is recurring subscription revenue. And so we're increasingly very much a software as a service organization, which has been a bit of a transformation over the past 18 months when we had about equal weight in terms of revenue across all those three segments. One of the core pieces of our investment thesis is, frankly, because we were generating material free cash flow, we seek to reinvest that cash flow that we don't invest inside of our businesses into acquisitions. And why this is so compelling in this ecosystem is there are a handful of, there's lots of accidental entrepreneurs in this ecosystem, meaning we have developers who started with a simple product, often scratching their own itch because they had done e-commerce in a prior life, and they saw a need in the market, and they developed a wonderful product with wonderful customer service, and they took that concept from 0 to 1. Where we come in is we try to take those concepts from 1 to 10 or 1 to 100. And we do so in a very founder-friendly way, where we work backwards from what the founder is looking for. We don't have a particular affinity to having the founder stay or go with the business. We're experienced with these sorts of smaller companies. And we're really providing an alternative to private equity as well as venture capital, and that we have very simple, kind of straightforward, easy to understand deal terms. We go through a diligence process quite quickly because all we do is e-commerce technology. And with frankly, a bit of a small team, we cover the vast majority of the actionable opportunities in this ecosystem. And so that has led to us building a brand for founders, by founders in this ecosystem, where we're able to get non-competitive acquisition opportunities. In fact, the most recent one, Archetype, the founders essentially told us that they weren't looking to sell, but if they were looking to sell, they would choose WeCommerce. And so we obviously love those sorts of opportunities, and we continue to have lots of those interesting opportunities in our M&A pipeline. Turning to our recent acquisitions, as I mentioned, we've deployed around 140 million US in announced acquisition value this year. We acquired a business called Stamped, which was a wonderful business that was doing around 11 million of annual run rate revenue at the end of last year, with 66% EBITDA margins and 125% net revenue retention, again, all at the end of Q4. It's a leading provider of reviews, ratings, loyalty, and rewards for mid-sized merchants, which we define as those doing around $1 to $50 million of GMV in a given year. And with its 13,000-ish paying customers, is less than 1% of the addressable market penetrated. Most recently, we added a wonderful provider of premium themes. And in fact, it's the most popular provider of themes in the Shopify ecosystem. We acquired that business for 5 times EBITDA upfront, showing the benefit of us being one of the key players in this ecosystem, the lack of competitive bids, especially for some of these companies, and our desire our founders' desire to be part of the WeCommerce umbrella. And so the founders, Carson and Paul of Archetype, are still with our business and are doing what they love, which is developing and designing product. We keep a fairly clean capital structure. We are profitable. We have around 25 million of cash on the balance sheet. We have a long-term debt facility arranged by JP Morgan with very low cost. And we have ample liquidity, meaning cash as well as available borrowing capacity to further invest in this ecosystem. Just a quick update as we recently announced our Q3 results. As I mentioned, we generated around 11 million of revenue for Q3 with a 31% EBITDA margin. On a constant currency basis, that's up 101% versus last year. For the 9 months ended September 30th, generated over 26 million in revenue, again with a 31% EBITDA margin, adjusted EBITDA margin, representing, at least on the revenue side, 90% growth over the prior period on a constant currency basis. And so we've really transformed the business over the past year. We're lucky to have some phenomenal shareholder support. We're lucky to have a wonderful team of colleagues, including Dave, who recently joined us from Taiga, and prior to that was at Redney. And I think with that, I can open up to any questions you may have, Dani.
Thank you. So just a couple of questions that I have here. Can you give us a brief overview? Oh, no, you have. Why is the ecosystem surrounding Shopify different than those around other e-commerce platforms?
Yeah, I think one of the
or maybe you can get out of the presentation so we all can see you guys.
Sure.
Thank you.
Yeah, of course, Danny. So one of the key differences, and we've been around in this ecosystem for quite some time, is that they've really been investing in it for the better part of a decade. And they started with building an agency partner network. They then reached out to designers to build premium storefronts, and most recently, I guess for the past 6 years or so, have really reached out to the developer community to build applications that enhance the functionality of Shopify. And other companies in this space have taken much more of a build internally sort of approach, whereas Shopify has taken a free market approach, which takes longer, but has benefited because simply the merchants in Southern California versus Estonia have very different needs. They're selling very different products, very different go-to-market approaches. And even as something simple as whether you're buying one time or subscription is actually a complicated kind of technical architecture to set up. And so Shopify has really invested in it. They've made it easy to become a developer. And most recently, they lowered the commission rate that they charge on their app store down to 15% with the first $1 million of earnings free. And so if you compare that against any other app store, whether that is from Salesforce or Google or Apple, it is among the lowest commission rates. And the CFO of Shopify recently said that that change was probably the most impactful strategic change they've done in quite some time. And so they're really focused on this developer community. And likewise, so are we.
Now, of your three segments, apps, themes, and agency, where are you spending the most efforts?
Yeah, it's a good question. So we, as I mentioned, about 18 months ago, our revenue was about a third across all those segments. Now it's about 2/3 apps, 10% agency, with the remainder being themes. And so we're clearly spending more time in apps and themes, given that's the revenue growth, that's the acquisition opportunity, and frankly, those are stickier and higher margin businesses. And so we acquired this business called Stamped in April 2016 that effectively doubled our ARR overnight, and it's just a wonderful little company that we're continuing to integrate and continue to invest in, and that's really catapulted our apps business in a wonderful direction. As I mentioned, we acquired this themes business back in August, and so as we think about the future, it's investing in the digital products, i.e. apps and themes, which play nicely together, because if you think about themes, it's a storefront, it's a top of funnel product. So when a merchant is just starting their store, they'll buy one of these themes, and we sell about 70,000 in a given year. And those merchants are naturally looking to build their storefront out, including with functionality. Ideally, that comes from applications that we offer. Doesn't have to be, because we can't serve everyone. That being said, it's a very attractive touch point to being at that high at the top of the funnel for those types of merchants. And so together, apps and themes play nicely together, and that's where we're investing the bulk of our resources and time and energy.
How much integration do you do with acquired companies?
So we very much fashion ourselves as decentralized, kind of high autonomy owners of companies. And so we don't take a private equity approach. We don't have a short-term holding period. Ideally, we look for companies that we can hold forever. And so anything that's customer facing, i.e. customer service or sales and marketing or product development, is naturally at the forefront of those companies. There are certain aspects that we do integrate, i.e. finance and legal, in order to provide that kind of back office support, and of course maintain compliance as a public company. Some of those things are very much required, but we really do value that high autonomy approach, and we think that creates a better customer experience, a better innovation environment for those customers. At the WeCommerce level, we have a portfolio operations team that helps surface insights across portfolios, enable cross-portfolio collaboration, and just help enable kind of a data-driven decision-making through a shared analytical infrastructure layer. And so you can imagine we get an immense level of granularity, both from our companies, because everything's digital, as well as through the hundreds of companies that we diligence in a given year. And that wealth of data really provides tremendous benchmarking, a tremendous access to best practices, an opportunity to share case studies throughout the portfolio company, and really help those companies to go from 1 to 10 or 1 to 100, which is the point of joining us in the first place.
And maybe my final question is, how did COVID affected your world?
Yeah, so COVID was obviously a massive accelerant in 2020. You saw both new merchant growth as well as increased kind of GMV per merchant, and Shopify benefited obviously tremendously from that run. And because we're part of that ecosystem, as did we. And so we've, now that we're a year out, we're looking at the kind of cohort behavior of those customers, and are they kind of flash in the pan sort of customers? But I think the reality is they're incredibly durable customers at the end of the day. And so now in kind of Q3, we're seeing, tougher comps, just simply because the year-over-year growth rate is not as high as it was last year. But it's really been a wonderful accelerant that has resulted in some permanent shifts. And I think away from e-commerce, it just shows that you can really be an entrepreneur anywhere in the world. And so we see companies developing apps and themes in kind of the more remote areas of the world, certainly away from major metropolitan areas. And the fact that we're enabling entrepreneurship and facilitating kind of access to capital in those markets is a tremendous thing that kind of helps them wake up in the morning.
Thank you. So I'd like to thank you and David that I managed to fix his name pretty early on. Thank you for joining us from LA and Toronto.
Thank you, Dani. Pleasure to be here. Thanks again.
Hope to see you soon, as I said to everybody at our in-person events. And my next speaker is Mike Reinhardt, founder of Acquisitive. He founded the firm in 2016, served as its chief executive officer and board director. The firm's ticker is QUIS. They are a premier global Microsoft partner that harnesses the Microsoft platform and complementary technologies. Mike will talk about that in a second. He has grown the company quickly, focusing on a geographic scale through organic growth and strategic acquisitions, industry services and solutions, and the development of first-party SaaS solutions. So, Mike, where are you this morning?
I'm actually in Austin, Texas, with my team. We're doing a leadership offsite here in Texas. I've got my entire leadership team together for a 2-day session.
I'll just tell you that in February, we have both our Dallas and Houston conferences. So hopefully you guys can check it out. I'll let you take it from here, and we'll later on do some questions. Thank you.
Yeah, fantastic. Thanks. Appreciate the opportunity to spend a few minutes with you guys here today. Take you through a little bit of the overview of Acquisitive and who we are. In the meantime, I'll start off with a little bit of my background. I've been in the technology industry for well over 30 years. Spent my early years as a participant in a large biomedical device manufacturer, Medtronic, where I traveled the world, really kind of being this center point between the technology organization and business, with this unique understanding of what technology can do, but more importantly, how it can bring value to the business and create business outcomes, and had a fantastic opportunity to learn and grow through that process. But over the last 25 years, have been building technology services and SaaS-based companies that do that for many enterprises rather than inside the four walls of one. And we'll talk a little bit about it, but along the way have built a really close relationship with Microsoft as they go to market through a partner-led model, and have been building out premier partners with Microsoft for the last 20-some years. One of very few that's fortunate enough to meet one-on-one with Satya Nadella, their CEO, and engage with their leadership in how to really drive value to their customers using their technologies. We'll talk a little bit about that. Our mission is really centered around these three pillars you see on the screen here. One is around the idea of what we call our cloud solutions business. It's really using all the capabilities that Microsoft has in the context of a business to really reach, engage, convert customers and employees, and leveraging the Microsoft cloud across all of their aspects, including their sophisticated ERP platforms and CRM capabilities, their Azure cloud on both infrastructure and data and analytics and machine learning and all the things associated with this, as well as what they call Microsoft 365, their collaboration tools for messaging and Teams and their security platforms. And we're experts in those. And we'll touch on that a little bit, and building a scale business in partnership with them. The second is we have this unique offering that we've built based on some expertise in the payments and retail space. We'll talk a bit about it, but really helping organizations rethink how payments are done and turning payments information and transaction leveraging the cloud as a mechanism to really allow retailers and other merchants to engage customers in unique ways and really enhance their operational effectiveness, more importantly, and engage consumers in new ways. And then in parallel with that, we use an M&A strategy to build and grow and scale the business accretively on both sides. We'll touch on that a little bit. To give you a pro forma view of us at a glance, obviously, because of M&A and things, the full financials in the public realm may not fully represent what we have in-house given timing of those acquisitions, including a very recent one we did. But collectively, we're 165 million US revenue business on a run rate basis. About 43% of that is fully recurring and transaction-based revenues, running at about 18% adjusted EBITDA at the moment, while still investing heavily in a product that we're about to release here in early in the new year. We'll talk a little bit about that. Strong footprint of global customers, 15 employee hubs, heavily footprint. We are headquartered in the US in Dallas, with a listing office in Toronto, but then strong presence across North America, as well as offshore capabilities in Hyderabad, as well as in South America, and over 700 employees in the company today. So the cloud solutions business, just for context, again, we're this rich partner with Microsoft. This is a high growth area. And if you think about digital transformation and the investments being made to really think about how to leverage this new capability in the cloud and all the really modern new technologies that you hear about, artificial intelligence, machine learning, IoT at the edge, and all of those, and bring them to customers to bring value. And we'll talk a bit about how we do that. Acquisitive was founded on this foundation of deep expertise in the Microsoft cloud and understanding all of their technologies and really helping organizations in the journey from the cloud. It's not only moving to the cloud. You hear a lot of IT services company talk about move. That's a commodity service that has a shelf life over the next 2 to 3 years. People will have made that transition. We do very little of that, to be honest. We're all about operating and, more importantly, innovating in the cloud and really thinking about how do you use all this new powerful capability to bring new value to the business, engage employees in new ways, optimize supply chain, and do things like that. We do this through an industry-led perspective. And it's really bringing, centering our expertise around retail and manufacturing and healthcare, and bringing that and combining that with a set of IP and SaaS offerings, as well as managed services that we have that really engage the customer and get them well in their journey, and then wrap that with very sophisticated systems integration services and things like that. We partner with Microsoft, and as I mentioned, Microsoft relies heavily on a partner ecosystem to engage customers. They themselves aren't a services engine. They have a very small services organization. They have this unique set of technology and offerings that by themselves are not finished goods. They're piece parts that require sophisticated technology services to bring them together. We're highly viewed inside of the Microsoft ecosystem. We were just recently named the 2021 Microsoft Worldwide Healthcare Partner of the Year. In 2019, we were the United States Country Partner of the Year, which is the highest award they give to any partner in the world. We have a host of advanced specializations and unique capabilities that are all audited and verified by Microsoft to ensure that we bring rich set of services to make their technologies in the enterprise and with their customers come to life in a way that brings value and allows them to capture recurring revenues through Azure cloud consumption and other kinds of things like that. We've got a set of IP that we have that are SaaS offerings in healthcare, in public sector. We've got an HR performance management solution that we bring to bear, MASIC platform that we have that's all centered around things in the shop floor and connecting and monitoring shop floor production. Those offerings are all brought into this industry, all built using Microsoft Cloud technologies. We wrapper that with very sophisticated understanding about how to do modern application development, how to deploy secure infrastructures in the cloud and protect against everything from fraud to cybersecurity risk. We have a whole host of managed services capabilities that we help organizations optimize and operate in the cloud. Our ideal customer is focused heavily in the US. These are mid-market customers for US, which is about a $500 million to $5 billion revenue business, selling typically into the C-suite. Very sophisticated digital marketing go-to-market where we're driving inbound leads through that engine. We have over 50 direct sellers and pre-sales resources that are on the streets throughout the US and Canada, interacting with customers to bring our value to them. And we have this really unique position with Microsoft where they've introduced us to over 400 customers in the enterprise space over the last 2 years because of our unique expertise in their product, our focus around helping them win and secure the landscape and bringing that to them as their preferred partner to go and bring value to their customers. So that's a little bit about the cloud solution side. That piece of the business of the 165 million I talked about is about 125 million. Very strong business, growing 15 to 20% organically and very accretively through key acquisitions, including recent ones that we've done that I'll touch on. The other side of it is there's this payment solutions component that's really about us really changing how payment processing is done. It's a very antiquated industry built on 30 and 40-year-old technology that's very behind the times and not enabling merchants to do the things they need to do, and a significant growth opportunity. We often get asked, how did we get into this? And because of this deep expertise we have about building out software and capabilities for customers, we have a really unique insight to know and understand how to build software where we have expertise in software development and engineering. And we got engaged with a consortium here in the US called Merchant Customer Exchange, MCX. They were formed by the top 40 merchants in the United States, led by Walmart, Best Buy, CVS, Target, Shell, Phillips 66. All of these businesses who viewed payments as a non-value added tax, highly complex, very antiquated, and not enabling their business. We identified for MCX that there was an opportunity to leverage the public cloud to really be a disruptor and change how merchants connect with Visa, MasterCard, and do settlement. And in fact, MCX had grand visions of replacing Visa and MasterCard at some point. And we actually ideated with them and built a pilot that showed that you could connect merchants like Best Buy and Shell and Phillips 66 between Chase Bank and those merchants to process transactions using the cloud as an enabler, as a PCI compliant capability, which had never been done before. MCX and Visa were in a major lawsuit at the time, and the merchants in general. And Visa settled that lawsuit for nearly $7 billion. And MCX was disbanded, but what it gave us was this insight to this incredible opportunity to disrupt an industry. And we've embarked upon building the first cloud-based payment processing platform that connects merchants directly with Visa, MasterCard, does full authorization and settlement for acquiring to facilitate payments both online as well as brick and mortar in the context of restaurants and convenience stores and any other retailer that has a hybrid model. So we built that out. Microsoft actually co-engineered the product with us. They've had engineering teams working side by side with us to build out what we call LedgerPay as our payment processor. In addition to that, we identified there's this really unique opportunity where these merchants many of them have no idea who you are as a consumer. In the context of Amazon, we all think of our experience today there. They know everything you've ever bought, everything you've ever looked at, and anything that anybody like you has looked at, and can do these very rich, personalized promotions to you real time as you're engaging with them. Think about quick serve restaurants and convenience stores. If you go to a fuel station and put your credit card in and buy fuel, and then go inside a convenience store and buy sodas or snacks, they have no idea who you are. Many of them have spent tens of millions of dollars in loyalty programs, but they have very low adoption. Less than 5% of their consumers are known to them. So they have no way to richly interact with that consumer to know who they are, how they buy, and how to personalize promotions to them. So as part of our LedgerPay platform, we've created an offering we call Payments Intelligence. And Payments Intelligence is all centered around this unique position we're in as the payment processor to be able to use your form of payment, whether it's credit, debit, whether you dip, tap, swipe, use a mobile wallet, doesn't matter. We can track and know who you are every visit that you've made. Further, we know what you purchased. When you're at the fuel pump, we know how many gallons of fuel you bought, what grade of fuel you bought, did you go inside, and what did you buy? And using that real time at the point of sale, because we interact with the terminal devices and the point of sale platforms, is we can take that data and then not only authorize the payment using our LedgerPay platform, but now having a model using Microsoft AI and machine learning capabilities, take that and apply that model to know what's your profile, how have you bought, how have others bought, working with the marketing organization of these businesses, now be able to present personalized offers to you based on that real time as you're standing at the fuel pump, pumping gas, motivating you to go inside the convenience store, which is where they really make their money. So that offering is all our Payments Intelligence platform. And we're in the final stages of full commercialization of this and launching that platform early next year. The merchant services side of our business, we went out and acquired a business called BankCard USA, and they have 7,000 merchants that they provide payment processing services through, and bank settlement and onboarding and things. What we will be doing is that's about a $40 million business doing about 14 million in EBITDA that we acquired earlier this year. One of their largest expenses is using payment processing services from First Data and TSYS and others like those. We will be migrating those merchants over to our platform, which creates accretive value in $4 to $5 million a year by us taking over that processing that all drops to the bottom line. So complementing these strategies from both of our cloud business as well as our payments business is the idea of using M&A. And as I touched on, we've done 4 acquisitions in the cloud solutions side, typically buying businesses 10 to 50 million in revenue, EBITDA in the 10 to 15% range, having unique specialization geographically, industry, et cetera, with IP. Most recently, we closed just this past month in November, an acquisition with Catapult, which is a $52.5 million trailing 12-month revenue business with 35% of those services recurring in a managed services model. Same thing on the payment side. We're looking to acquire these portfolio of merchants that we can accretively bring over, like BankCard that we've acquired, as well as other ISVs that might have point of sale platforms or other kinds of solutions that we can integrate into it, and using our capital and our access to the markets to build accretive value through an M&A process as well. We bring that all together in a very cohesive OneQuisitive foundation. We don't buy companies and leave them off independently and report the news. We don't think that's how you create accretive value. That typically has some limited value created through cost synergies. What we look to do is create meaningful integration synergies with cross-selling of services across the different businesses, integrating our cloud solutions capabilities and payment solutions and data capabilities at the point of retail jointly with Microsoft as we go to market, and bring all of that together in a fully integrated brand strategy, integration of team and business, as well as systems across the business. A quick snapshot on the Acquisitive business. So we recently reported Q3 results, about 27.8 million. These are all US dollar. We report everything in US dollars. Of that, about 10.4 million, it is associated to our payments business. Adjusted EBITDA of about 5.2 million, although we're investing heavily still at the moment in our LedgerPay platform. So that would be much higher if we weren't in the final throes of commercialization of what we think is an exciting opportunity with our LedgerPay payment platform, which is going to be the first cloud-based payment platform around. You can see some of the other things. The growth of the business continues to be strong. We'll finish this year near about 95 million and a strong position to scale and grow well beyond that as we activate our payments and continue the integration through an M&A process. So that's what I had to share today. Happy to turn it back over for any questions that you might have.
Thank you. We have basically 4 minutes, so quickly I'll ask. I understand from your discussion that Microsoft has a thorough partner model, but does Microsoft not have their own team doing what you are doing to some degree, and you're not really competing with them?
Yeah, no, actually not. They have a small services footprint, Microsoft Consulting Services it's called, but it's actually a very small team. And that team focuses on the very largest enterprise customers. They're out working with customers doing multi-$100-million initiatives on the latest and greatest things to make sure that they go successful in early stages of product. But at scale in that mid-market that I described, they fully rely on a third-party partner channel to go provide those services to customers.
Thank you. And how does being a pure Microsoft technical shop impact your customer growth? Some customers might be looking at Google and Amazon cloud servicing.
Yeah. So again, when you look at mid-market, very few mid-market customers have a multi-cloud strategy. They either bet on Microsoft, bet on Google, or bet on Amazon. The reason in mid-market, and Microsoft is dominating that space, is because of the depth of their products. I talked about when you think about Google and Amazon, they have a much narrower set of offerings. They have no CRM platform. They have no ERP platform. They don't do all the Microsoft 365 stuff. Google does a little bit of it. Amazon does none of it. They're the only one that provides that cohesive opportunity. And by us dedicating to it, Microsoft is willing to introduce me to 400 enterprise customers because they trust that I only win when they win. They wouldn't do that with any other partner that was a multi-cloud partner.
Thank you. And my last question is on the payment side. What type of companies are comparable to LedgerPay? Do you consider yourself to compete with direct payment processors or fintech solutions?
Yeah, so there's a whole host of them. We described the tip of the iceberg. You got the Stripes of the world that do a lot of the really high, cool front end stuff with customers, but not the stuff that's below the water in the iceberg that might be provided by the First Datas and TSYS. We do all of that. We do the rich onboarding with merchants and ISVs like a Stripe and others do, but we also do the things that a First Data and TSYS and all the big payment processors do because we're an endpoint directly connected to Visa, MasterCard, and there are very few of those companies in the United States.
Thank you, Mike. So your ticker is QUIS. Thank you so much. I hope to see you soon at our in-person conferences as well.
Fantastic.
Thank you.
Thanks so much for your time.
Thank you. And it's been a great experience. I had a ball speaking here with four great Canadian companies today. And I will just mention that my next session is this Thursday, when we'll be talking about generating arbitrage alpha through tech-centric VC and PE opportunities. And I'll speak to some of our very interesting friends about investments generating arbitrage alpha. I'll speak to Pala Capital, which is a group of serial entrepreneurs developing the world's most dynamic personal wealth creation platform. And we'll be back with our conferences in person next year. In February, we're in Houston and Dallas. In April, we're in Montreal, Vancouver, and Toronto. In June, we're in the Middle East, UAE, Israel, London, Europe. And then the second half of the year, we're in Chicago, New York, Miami again, and we will be doing also our sub-conferences, as some of you may know, our technology conferences. Some of them are about blockchain, some of them are about technology in general, and our real estate conferences that we're doing with the legal firms in Canada, United States, and the UK. Until then, stay safe. I'm Dani Sheridan. Thank you for being with us today. Thank you, and see you soon.